All right, so next we want to talk about part B, and here we're looking at different topics dealing with the various uh, steps 1 through 5 that we've talked about in part A. So special circumstances there, and then we'll end it with talking about required disclosures. So step 1, the topic we'll deal with is uh, certain special contract issues. Step 2, prepayments, warranties, customer options for additional goods or services. Step 3, variable consideration, right of return, seller as principal or agent, time value of money, payments by seller to customer. Step 4, various approaches to estimating standalone selling prices. And step 5, licenses, franchises, bill and hold arrangements, consignment arrangements, and gift cards. All right, so as far as step 1 is concerned, contracts, like I said, they can be oral or written, but as well as that, many and most are explicit contracts, but sometimes contracts can be implicit based upon typical business practices. So imagine you're at a store and you you basically come with a clothing garment to the counter, and they ring you up. I mean, uh, implicit there is the fact that you've got a buyer and a seller who are agreeing, the buyer to buy the garment and the seller to sell it for a particular price. So, you know, it's kind of a lame example, but that's the one they give in the book. Most contracts are explicit, though, but they can be oral or written, as we've already talked about. Contract only exists if it has commercial substance, if it's approved by both the seller and customer, all the uh, basic uh, terms at least, specifies the rights of the seller and customer, specifies payment terms, and it's probable that the seller will collect the amounts they're entitled to received under the contract. Contract does not exist if neither the seller nor the customer has performed any obligation under the contract, and both the seller and the customer can terminate the contract without penalty. So you have to have both of those things to show that a contract does not exist. So here we have an example, basically our running example. Comp Stores ordered 1,000 Tri-Box systems on December 20th, 2017 at a price of $250 per unit. Assume that Comp Stores and TruTech can cancel the order without penalty prior to delivery. TruTech made delivery on January 1, 2018 and received $250,000 on January 25th, 2018. When does TruTech's arrangement with Comp Stores qualify as a contract for purposes of revenue recognition? Well, the key here is Comp Stores ordered 1,000 Tri-Box systems on December 20th, but either party can cancel the order without penalty prior to delivery. Okay? So, anytime prior to January 1, there was no contract. I believe the answer is January 1, when one of the parties performed what they were obligated to do. All right, special issues for step 2, identifying the performance obligations. The following are not performance obligations. Prepayments. As you can imagine, some contracts require upfront fees that are non-refundable. Gym memberships is the one that they use in the book. And so they note that these prepayments are not considered to be performance obligations because they aren't a promise to transfer a product or service to a customer. Instead, the upfront fee is advance payment for future products or services and should be included in the transaction price and allocated over the various performance obligations in the contract. They should be initially recorded as deferred revenue and recognized as revenue when or as each performance obligation is satisfied. Quality assurance warranties. And let's so many products, when you buy them, have like a 1 year quality assurance warranty. And these warranties are not separately sold. And also, they can be either explicit or implicit based upon normal business practice. Quality assurance warranties are not a performance obligation. Rather, they are a cost of satisfying the performance obligation to deliver a product of acceptable quality. The seller recognizes the cost in the period of sale as a warranty expense, and they have to list a contingent liability. Again, contingent liability there, just like a lot of things, you have to estimate the amount excuse me, that you believe the future warranty liability will be. It's not an exact science, but there's a lot of times where you're not dealing with an exact science here. Bad debt expense is one. And so this warranty expense stuff is another. Right of return. Let's see, where is this? I don't even see that in here. Oh, this is on page 251. This is actually under step 3, but anyway, I guess we can talk about it. you know, if you buy something and you don't like it, it's not uncommon for retailers to give a right of return if you don't like something, not satisfied with it. So this right of return does not create a performance obligation either. Instead, it represents a potential failure to satisfy the original performance obligation to provide goods that the customer wants to keep, because the total amount of cash a seller is entitled to receive depends on the amount of the returns. A right of return creates a situation involving what we call variable consideration. But what you can do, just like with a lot of things, the seller can estimate the returns that they believe uh, will come back to them based upon past experience, and so they reduce the amount of revenue by the estimated returns and record a liability for cash the seller anticipates refunding to the customer. So you see that they have what's called a sales returns account, which is a contra revenue account. And so you estimate the amount that you expect. So your debit would be to sales returns and your credit to refund liability. Now the book says in practice that most companies don't do it like that. They just as returns arise, they uh, debit sales return and credit cash as they occur, and then they make appropriate adjustments to sales returns and refund liability to account for their estimate of remaining returns. Now, going back to warranties, unlike a quality assurance warranty, many companies offer what are called extended warranties. Now, this uh, usually requires the buyer to spend extra money on the extended warranty. And so a warranty is an extended warranty if either the customer has the option to purchase the warranty separately, or the warranty provides a service to the customer beyond quality assurance. And so that is considered a performance obligation, the extended warranty, and it's a separate sales transaction. The price is recorded as a deferred revenue liability and then recognized as revenue over the extended warranty period. If the extended warranty is included along with the related product as a part of a single contract, then the extended warranty is still treated as a separate performance obligation and is allocated a portion of the transaction price, and that portion of the transaction price is recorded as deferred revenue, kind of like we did with the Tri-Box two product example that we did yesterday. Same sort of allocation would occur. Sometimes you'll have what are called options. These are a material right, and this material right is usually to purchase additional goods or services. And so the right usually means that they get to purchase additional goods or services at a discounted rate when compared with buying those items separately. And so here again, when you have such an option that provides a material right, then part of the contract's transaction price is allocated to the option. Again, the allocation process requires the seller to estimate the standalone selling price of the option, taking into account the likelihood that the customer will actually exercise the option. And so here we have an example of that. TruTech offers a promotional coupon with every try box it sells for the normal price of $240. The coupon gives the try box customer an opportunity to buy for $90 a headset that normally sells for $150. Hold on one second. I want to check something. Just want to make sure I'm recording. It's one of those OS moments where you go, did I start recording? I don't want to do this for a whole hour and then find out I didn't record it. All right. So they offer a promotional coupon with every try box it sells for the normal price of $240. The coupon gives the try box customer an opportunity to buy for $90 a headset that normally sells for $150, which is a 40% discount. The coupon must be redeemed within 1 year of the try box purchase. And TruTech estimates that 80% of the customers will take advantage of the coupon. How would TruTech account for each sale of try boxes, of 100 try boxes sold under this promotion on January 1, 2018? All right, so we estimate the standalone selling price of the coupon. The discount is $60. We know that. And so the estimated standalone selling price is $60 times 80%, which is the estimate of how many customers percentage-wise will take advantage of the coupon. Next, you're going to add that standalone price of the coupon to the price of the box. I want to say Xbox, but that's not right. And what you get is $288. And next, you're going to divide for the try box the $240 selling price into the total standalone selling prices of both items, the box and the right to purchase this at a discount, which is $288. And so what you come up with is 83.33%. So you're going to take, and of course the coupon is going to be 16.67%, and then you're going to do your allocation accordingly. And so here for the try box, 83.33% times 240 times 100 units sold equals $20,000. And then, and again, you could certainly use 5/6 and 1/6 instead of the percentage. There, it's going to be 1/6 times 48, excuse me, 240 times 100. So the other 4,000 gets allocated to the coupon. And note that when you're doing your journal entry, because the coupons are not optioned yet, but will be sometime in the future by these buyers, the seller must defer revenue on the coupons. The revenue on the boxes gets recognized right away on delivery. Scale Company offers a promotional coupon with every product it sells. The coupon gives the Scale Company customer an opportunity to buy an electric grill that normally sells for $50 for only $30, a 40% discount. The coupon must be redeemed within 1 year of purchase. Scale Company estimates 80% will take advantage. What is the standalone selling price of the coupon? Correct answer is D. So what you do is take 20, the amount of the discount, and multiply it times 80%, the estimate of those you expect to be redeemed, coupons you expect to be redeemed, and you come up with $16. Hooper Company offers a discount on an extended warranty on its iPhone when the warranty is purchased at the time the iPhone is purchased. The warranty normally has a price of $300, but Hooper offers it for $240 when purchased along with the iPhone. Hooper anticipates a 75% chance that a customer will purchase the extended warranty along with the iPhone. Assume Hooper sells 100,000 iPhones with an extended warranty discount offer. What is the total standalone selling price that Hooper would use for the extended warranty discount obligation for purposes of allocating revenue among the performance obligations in those 1,000 iPhone contracts? Okay. So the answer is 45,000, and they come up with it by, again, taking the 60, the amount of the discount, and their estimate of 75% chance a customer will purchase the extended warranty along with the iPhone, and simply multiplying it times the number of iPhones sold. All right, step 3, special issue. Let's see. Where do we want to go with this? All right, so we're going to talk about estimating variable consideration and determining whether it is what they call constrained, sales with a right of return. We already kind of saw that. Identifying whether the seller is acting as a principal or an agent, time value of money, and payments by the seller. Variable consideration. Sometimes you have in your contract some sort of clause that indicates that the transaction price depends on the outcome of some future event. And so, for example, in construction, you can have incentive payments, but you don't know. So the payments are based upon reaching some incentive uh, that's been put out there for the uh, company who's doing the construction, and so the buyer of the construction puts out this incentive to entice the construction company to basically do stuff in a timely manner and with good quality. Entertainment and media royalties are a variable consideration. Healthcare, Medicare and Medicaid reimbursements, manufacturing volume discounts and product returns, and then in telecommunications, rebates are variable consideration. And so here, what you have to do is um, when you have a situation involving variable consideration, the price depends on the outcome of some future event. What you have to do is figure out either the expected value or the most likely amount, depending on which estimation approach better predicts the amount the seller will receive. Well, what do you do if there are uh, several likely outcomes? Well, they say that if there are several possible outcomes, then use the expected value. And if there are only two outcomes possible, then the most likely amount would be the best indication to use. All right, so we have an example here. TrueTech enters into a contract with Pro Sport Gaming to add Pro Sports online games to the TriNet network. Pro Sport offers popular games like Brawl of Bands and wants those games offered on the TriNet so Pro Sport can sell gems, weapons, health potions, and other game features that allow players to advance more quickly in a game. Terms of the contract are: on January 1, 2018, Pro Sports pays TrueTech an upfront fixed fee of $300,000 for 6 months of featured access. Pro Sport also will pay TrueTech a bonus of $180,000 if TrueTech users access Pro Sport games for at least 15,000 hours during the 6-month period. TrueTech estimates a 75% chance that it will achieve the usage target and receive the $180,000 bonus. And so they're going to take and estimate this. They're doing it based upon a couple of alternatives here. Alternative 1, the expected value. So possible amounts here are 480,000. They predict a probability of 75% of receiving that amount. So you take the possible amount times the probability to come up with the expected amount. It's also possible that they could only receive 300,000. And so that probability, they believe, is 25%. So they take and multiply the 300,000 times the probability to come up with an expected amount of 75,000. So you add those two amounts, and that would be your expected value of the contract price at inception, $435,000. Notice that the cash they received is deferred revenue because, again, this is for 6 months of featured access. Now, they could use most likely amount, and so here they believe that it's see what they're doing here. Here, I guess what they're saying is they believe the most likely amount is the 480,000. And so this bonus receivable of $30,000 is the $180,000 variable consideration based upon user use. Again, let's go back and look at our problem here. So they pay an upfront fee of $300,000 for 6 months of featured access. So TrueTech lists that as deferred revenue and accrues revenue over that 6-month period of $50,000. TrueTech believes that the most likely outcome is that they will receive the $180,000 if that's truly what they believe, and they're going to recognize that as a bonus receivable or $30,000 over that 3 months period. And then of course you're going to add $30,000 to your service revenue. So that's what they're doing there. They believe the most likely amount is the total of $480,000. In the first case, you're looking at a couple of different probabilities. So again, you'd have to look and see which method you use. Now, once they receive the bonus cash of 180,000, you're going to have that first entry there. And of course, if they don't receive the 180,000, then they'd have to reverse all the entries that they made, the receivables of 180,000, and of course back out the service revenue of 180,000. All right, so continuing, now assume that after 3 months, TrueTech concludes that due to low usage of pro sports games, the most likely outcome is that it will not receive the 180,000 bonus. So after 3 months, you've accrued $90,000 of receivables and revenues. So you just back that out up to that point, and for the other 3 months, you don't recognize the $30,000 receivable for each month. But you do accrue for the remaining amount. You're still accruing that $300,000 at $50,000 a month. All right. City enters into a contract offering variable consideration. The contract pays City $2,000 a month for 6 months of continuing consulting services. In addition, there's a 60% chance the contract will pay an additional $4,000 and 40% chance that the contract will pay an additional $6,000 depending on the outcome of the consulting contract. City concludes that this contract qualifies for revenue recognition over time. Assumed city estimates variable consideration as the most likely amount. What is the amount of revenue city would recognize for the first month of the contract? Okay, so you're going to have to do some allocating here. The answer is 2,666, and they come up with that by taking 4,000. All right, so what they're doing here is the likelihood of receiving the $4,000 bonus is 60%. So if that's the case, they would be paid a total of 2,000 times 6 months plus 4,000 or $16,000. And so what they would do is recognize 16,000 divided into 6 months, which is the 2,666. All right, basically the same deal, except they estimate variable consideration as the expected value. What is the amount of revenue city would recognize for the first month of the contract? Well, here it's going to be 2,800, and there you're going to take your 2,000 times 6 months, and then you're going to add the basically a weighted average of 60% times 4,000 plus 40% times 6,000 to that 2,000 times 6 months, and then so that's going to be 16,800. Of course, divided by 6, that's going to be 2,800 per month. All right, we're going to move past that, and we're going to move past that. Not sure where they are in here. Okay, right of return, I think we've already talked about this. So you reduce the amount of revenue by the estimated returns. Next, is the seller a principal or agent? Um, so, think of you hire someone to sell your house. You are the principal, you the house homeowner, and the realtor is your agent. The agent does not own the house. What they do is they contract with the seller, the homeowner, to sell their house, and what they receive out of it is a commission. What the principal gets out of it is the sales price paid by the buyer of the house, assuming the agent finds a buyer. And so the performance obligations here are the principal. You could also think of uh, consignment shops. You give your stuff to a consignment shop. You the owner of the property or the principal. The consignment shop is the agent, and they don't own the property. What they get if they sell the property is a commission as well. So you see the performance obligations here of both the principal and agent and how they would record revenue. So we have an example here. Mike buys a TriBox module from an online retailer for $290. Let's consider accounting for the sale by the two retailers, Princo and Agenco. Princo purchases TriBox modules directly from TruTech for $240, has the modules shipped to its distribution center in Kansas, and then ships the individual modules to buyers when the sale is made. Princo offers occasional price discounts according to its marketing strategy. Agenco serves as a web portal by which multiple game module manufacturers like TruTech can offer their products for sale. The manufacturers ship directly to buyers when a sale is made. Agenco receives a $50 commission on each sale that occurs. Whoa, what happened? All right, so when each sale occurs, Princo lists revenue at $290 per unit, less cost of goods sold of $240, so the gross profit is $50. For the agent, all they receive is a $50 commission. There is no cost of goods sold, so that's their gross profit. Clayton Consulting operates a website that links experienced statisticians with businesses that need data analyzed. Statisticians post their rates, qualifications, and references to the website, and Clayton receives 25% of the fee paid to the statisticians in exchange for identifying potential customers. Lovelace Associates contacts Clayton and arranges to pay a consultant $4,500 in exchange for analyzing some data. Clayton's income statement would include the following with respect to this transaction. So what does Clayton get? Well, he gets 25% of the consultation fee, right? So 1,125 because he's the agent, not the principal. Okay, I think that does it for step 4. Let's move to, or excuse me, step 3. Let's move to step 4. All right. Allocating the transaction price. They give you a couple of different ways of doing this. Um, the adjusted market assessment approach, the price if the product or services were sold in the market standalone. Number 2, the expected cost plus margin approach. Here you would just estimate the cost of satisfying a performance obligation and then add an appropriate profit margin. Number 3, the residual approach. There you would subtract the sum of the known or estimated standalone selling prices of the other goods or services in the contract from the total transaction price of the contract. So you estimate an unknown standalone selling price by subtracting the sum of the known or estimated standalone selling prices of the other goods in the contract from the total transaction price of the contract. The residual approach is allowed only if the standalone selling price is highly uncertain. All right, so we have an example here. Assume TruTech sells 1,000 try boxes with 1 year TriNet subscription at $250. Standalone selling price of the try box is $240. Standalone selling price of the 1 year subscription is highly uncertain because TruTech hasn't sold that service previously and hasn't established a price for it. Very simple. Under the residual approach, you would just take the total price of the try box with the TriNet subscription. Then you would subtract the standalone price of the try box to come up with your estimated standalone price of the TriNet sub. Here, assume TriTech sells try boxes with 1 year TriNet subscription at $250. Standalone selling price of the 1 year subscription is highly uncertain because TruTech hasn't sold it previously and haven't established a price for it. Under the residual approach, you would just do what we saw here. You would account for the total sale of $250,000. Sales revenue for the boxes would be $240, recognized with delivery, and the other $10,000 is simply deferred revenue because it's recognized over time. Allen Company wrote a contract that involves two separate performance obligations. Allen cannot estimate the standalone selling price of product A. Product B has a standalone selling price of $200. The price for the combination of products is $240. How much of the transaction price should be allocated to the performance obligation for delivering product A? Well, that's an easy one, isn't it? 40. All right, so moving to step 5, recognize revenue when or as each performance obligation is satisfied. So again, sometimes that gets kind of hard to do, and so they talk about different situations where that timing is complicated. Licenses, franchises, bill and hold arrangements, consignment arrangements, and gift cards. Let's see, where do I want to go with this? Well, they talk about two types of intellectual property that you can have a license to. Functional intellectual property. Um, there, you transfer a right of use to the intellectual property that has significant standalone functionality. So an example would be software like Microsoft Office, media content like books, music, and movies. And so for licenses of functional IP, sellers typically recognize revenue at a point in time that the customer can start using that IP. For example, downloading a song from Apple iTunes. Well, once you've downloaded that song, it's essentially yours. You have purchased a license to use that intellectual property. So revenue is recognized at the start of the license period in our example of a music download when the right is transferred. Another type of IP is called symbolic IP. In this case, what you get is a right to access the seller's IP with the understanding that the IP does not have significant standalone functionality. So the seller undertakes ongoing activities during the license period that benefit the customer. The seller might make changes to the IP over the course of the license or could perform marketing or other activities that affect the value of the license. Examples are trademarks, logos, and franchise rights. And so here, the seller of the license, symbolic IP license, recognized revenue over the license period. Usually there is a period of time that you can use the license, and it's stated in the contract what that license period is. The one exception to this for functional IP, it's viewed as transferring a right of access if both the seller is expected to change the functionality over time and the customer is required to use the updated version. And so the example there is virus protection software. Which of the following is not true? Licensing fees always are recognized. Anytime you see the word always, you can almost bet it's not going to be uh, true. All right, let's move on. Tired of this. Franchises often include a license to use intellectual property such as trademarks. Think of a Wendy's franchise. You have your initial sales of goods and services as well as ongoing sales over the life of the franchise. And so the franchisor, that's the Wendy's in my example, they must evaluate each part of the franchise agreement to identify the performance obligations and allocate accordingly. Which of the following is not true about accounting for revenue from franchise agreements or arrangements? Typically include one, performance obligations. Bill and hold sales agreements are usually met with a lot of skepticism. So what they're saying, buyer and seller say, the buyer says, okay, you can bill me for this item, but don't send it to me yet. So in that case, delivery hasn't occurred. And if you recall, that's kind of one of the important things to occur, delivery of a good or service, for there to be recognition of revenue. The reason why bill and hold sales are frowned upon is because there's a lot of situations that have occurred where at the end of the year, sellers are looking for revenue, and they would call up a customer and say, hey, can we bill you for this amount that you're going to buy in the future, and we'll just hold on to the product. Well, again, physical possession of the asset is still in the seller's hands, not been delivered, control has not occurred, so typically revenue can't be recognized until actual delivery to the customer occurs. Consignment arrangements, again, the the buyer, once they buy something that's sold on consignment, they pay the uh, consignee, the person who is selling the consigned products, and the consignor is the owner. They retain legal title. The consignee simply receives a selling price, or excuse me, a commission. Uh, and so what happens is the selling price less commission goes to uh, the owner of the property. Let's pass gift cards. You know that when you have gift cards, you have to have deferred revenue until they're used or they become um, expired. All right. 1 second.